welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, Barry Saywitz. Hey, Barry.
Hey, good morning, Paul.
Good morning to you. Well, we're on take two here. We had a little technical difficulty the first go round, but we're back.
We're back. We're going to try it again. And so it's too bad I don't have any cue cards or any notes to read from because I would then remember what I was supposed to say. But for today's show, I want to welcome everybody. The sun is out. It's going to be a nice day here in Southern California and in most parts of the country. We're going to talk some real estate today. We have an interesting show lined up today. It's a little bit different format than what we have done in the past. Every week we get different questions from our viewers and listeners out there that chime in and ask different things about either the show or what's going on. And so we've stockpiled that over the past several months, and we decided that we would do a show and call it the Mailbox Grab Bag Show and take some of those questions and address them and try and answer them. And so for those of you out there listening for the first time, I am Barry Saywitz, president of the Saywitz Company and managing partner of Barry Saywitz Properties. In my 30-plus years of doing commercial real estate, I've tried to look at both sides of the equation in structuring a transaction and surround myself with expert advice to be able to make sound business decisions. And so I'm hopeful that the people tuning into the show are able to pick up some tidbits of information that they can apply in their own business or in their own lifestyle on a daily basis. So welcome to the show. Before we get going, I do want to do a special shout out to my girlfriend and wish her a happy and belated birthday. I know I wished it to her in person. I didn't do it on air. I am hopeful that you had a wonderful birthday with many presents and special time together, and I enjoyed it. So happy birthday. With that said, we are going to go to the mailbox, and Paul has his hand. For those of you who can't see it, he's got his hand in a giant box, and there's there's either cookies or questions in there, right?
I think a little bit of both here today. Well, we do get questions from time to time, and again, we encourage people, if you do have something that you want to have on the air, please send us here at OC Talk Radio your questions. You can email, you can send them directly here. You can look us up online and get our address. But we get questions all the time about various aspects, and some of them seem simple, some of them are more complex. Let's start with one today. Patricia from Melissa Viejo. She writes, with the war in Ukraine and inflation running rampant, what impact, if any, do you see on apartment rents in Orange County? That's a strange connection to make. Is there a connection between the war halfway around the world and inflation and apartment rents?
Yeah, I'm not sure there's a direct correlation between the war and apartment rents in Orange County, but what I will tell you is there are a number of byproducts of what's going on in Ukraine, and that trickles down to gas prices, that trickles down to other inflationary impacts. And so what you have here in Orange County and throughout Southern California is you have high inflation. I mean, you have inflation at 8+%. You have everything costing more, from gas to groceries, to cars, to anything that you pretty much would do. I mean, I can tell you firsthand as a business owner, we have gotten price increases from every utility company, from the trash company, from all of our vendors and the janitors and you name it. And so that trickles down to higher costs for everything. Now combine that with a very tight apartment market because people are now not able to buy homes because of the inventory on the sales side, or because they're waiting to see what happens with the market, or because there hasn't been a lot of new construction during COVID, and you have a tight apartment market, you have rents that are at escalated prices, makes it very difficult to do that. So there is no simple answer to the question, but the short version of it is you're going to see apartment rents throughout Southern California continue to increase as long as there is limited supply. And unfortunately for the person out there that's a renter, you're just going to have to deal with that and address it as best you can in your decision making.
And let me ask you one follow-up question on my own here. So if things go up, do they ever come down again? Does gas come back to $4 a gallon? And do apartment rents ever adjust? I suppose if there's an oversupply at some point they might, but...
Yeah, you look, real estate does not go up forever. The stock market, as we have just seen here in the last 30 days, does not go up forever. So there are cycles and there are blips. The issue with the stock market, while there are many things that impact the stock market, I'm not going to begin to prognosticate as to what happens with that. But with the rents and the apartment market, you still are back to the dynamic of supply and demand. And you're also back to interest rates. And so as interest rates go up, I think that will slow down the robust real estate market on the home side. And at the same time, that will create less volume. There's already limited supply. So when you have limited supply, unless there's really a complete tanking of the economy, you're not going to see a big discounting of rents on the apartment side because landlords just don't have a lot of vacancy.
Yeah, right. Well, that leads to the next question. David from Anaheim writes something very similar. He says, I've been trying to buy a house for our family for quite some time, for the last 6 months, having difficult because it's a limited supply, and we keep getting outbid. So now that interest rates are going up, which I guess makes it more expensive to buy a home, should we just keep renting, or should we really push hard and get a home now?
Yeah, and I think that's a very good question and is really prevalent for a lot of people. And I've had conversations in the last couple of weeks with several of our own tenants that are renting from us that are trying to buy a place that are struggling as well. So, David's in the same boat. The issue is if you can find something that makes sense to buy, then you buy it. If you have to pay a little bit of a premium, the reality of it is that you're amortizing that mortgage payment over a period of 30 years. So just pick a number. If I was going to buy a home for $1 million and I had to pay $1,050,000 to outbid somebody to get it, that $50,000 is not $50,000 out of your pocket. That's amortized over the term of the mortgage.
Right.
So it might only cost you an extra $100 a month on your mortgage payment. And then you have to ask yourself, is that worth it? And do I get an additional tax write-off? So it's not really $100 after tax. And do I really want the place? And if I believe that I'm going to be there for a long period of time, if I believe that long-term property values will continue to go up steadily here in Southern California, then I say if you can find something that makes sense, pull the trigger and do it. Even though interest rates have ticked up, they're going to tick up again tomorrow when the Fed finishes its meeting by some amount. But long term, you're still at a very low rate interest-wise, and long term, you'll still be making a good, sound decision, and you own it rather than renting it. If you can't find the perfect place, and you're winding up overbidding and getting in bidding wars on places that are just not ideal, then I say you continue to wait, and unfortunately, you'll have to go back and renew your lease or continue to rent until you can find something in the future. But don't do something just because you want to buy it. Make sure you're going to like it because you got to live there.
Yeah. That leads to the flip side. My son-in-law is thinking of this one here. They have a condo in Tustin, and they're thinking of selling it and cashing in because he's just not sure the market will sustain itself. So he's going to take the money off the table, take his earnings, and rent for a while. And I said, I don't know. Maybe the risk is it'll just keep going up, and you'll have to pay higher to get back in the market, or maybe it will come down, and you'll be seen as a genius there.
Right, and those are all a bunch of very good what-if questions. And then the issue is, if you sell your place and you don't buy something else, then you will wind up paying a bunch of taxes. And so what is your tax implication, and how much are you making, and how much will you net at the end of the day? Is that worth it? For elderly folks who are looking at it and saying, hey, I don't really care if I own it or I rent it. I want to use the money to live. We have lots of investor clients who say, look, I'm just going to sell my house, and then I'm going to pay the taxes, and then I'm going to take my deductions, and I'm just going to use the money and go travel and have a good time, and I'm not going to worry about it. And so that's another philosophy. It's really a question of where you see the market going in the future. If you think that there's going to be a blip in the market and you go wait it out, you have to hope your timing is right as well as your judgment. So, it's two schools of thought. None of them have a horrible end result. You either wait for the place to buy and you buy what you want, or you cash out. You're going to make some money. And the question whether you're a total hero or partial hero, I guess, remains to be seen.
Remains to be seen. Well, here, let's switch gears from homes and apartments to the office market here. I hear this question all the time. Joshua from San Clemente writes, I'm currently working from home. Most of my staff is working from home. Is this going to create less need for office space going forward? And what does that do to the overall office market here in Orange County?
Yeah, and I would say for Joshua, or for any small business owner or business owner for that matter, there's no question that COVID caused people to rethink how they use their office space. and how their people are staffed and how that works. And so for some businesses, we've talked about it on several shows. For some businesses, they need the synergy. They need people to be coming into the office and to interact with folks. And so it really, at the end of the day, it didn't change the dynamic of the workforce or how the people integrate. There are other companies that simply don't need that, and so they have staff going 1 week in, 1 week out, or they just have people working from home and don't really care as long as they get their work done. So what we've seen in the office market is certainly you had a blip and a dip in the desire for office space because people either needed less space or different space or no space, or small companies decided to work out of their house and just forget the office space completely, and it created more vacancy. What we're seeing now is people are now back to work. The mask mandate's over. COVID is still around, but it's not the death trap, and people aren't panicked, and so you have to move on with life. And you see companies trying to hire more folks, right? They are growing. They are trying to hire. And you're back to people taking more or different space. And so now the question becomes on the office side, am I going to retool my existing office space so I don't have to move? Can I remodel it? Can I reconfigure it? Can I shave off some space? Or do I just go look for different space? And I think as time goes on, you're going to see more of that. It's going to take longer for the office market to recover than the other sectors, but we've already seen the activity on the office side significantly increase.
Well, let's switch gears again. I'm flipping through the mail here, and I see a couple about industrial spaces here. This guy is, I think it's Matthew from Fontana, writes, I own an industrial distribution company in the Inland Empire. We've been looking for a building to either buy or rent for the past several months and have found nothing. What do you attribute this to, and do you see any of that opening up later in the year?
Yeah, and so that's attributed to several factors, but the underlying factor is almost no vacancy, right? There is limited new construction. The new construction that exists are mostly really big buildings that are getting gobbled up by these 3PL, third-party logistics companies, or Amazon-type, Walmart-type distribution facilities. And so if you need 20, 30, 50,000 square feet, these bigger 500,000 or 1 million square foot facilities, they're not going to divide them down for you, which leaves limited inventory. And so with limited inventory, you have prices increasing, and with the rents near the port really just skyrocketing, then people have looked to move further east, which creates just more demand out in the Inland Empire. So vacancy out there, depending upon who you talk to, is 1% to 2%, but wow. We have clients of ours that say, hey, I need, I don't know, pick a number, 30,000 square feet of warehouse. I have to have a minimum of 24-foot clearance in the warehouse to do my racking. I need so much office space, and I need a little bit of a yard area, and I need so many doors. And you might have 10 things to pick from, and when you're done chipping it down to the ones that fit your criteria, you have like one. And then you go to put an offer in on the one, and you got 4 other people bidding on it, and somebody says, I'll take it on Monday, it's available Friday, and you're like, wait, I can't move that fast, and now it gets lost. No different than David, who was looking to buy the house, who's struggling with it. The guy who needs small to middle-size industrial space in the Inland Empire, really, for that matter, anywhere in Southern California at this point, is going to really struggle to find good, viable options. And then when they do, you're going to need to either jump on it, overpay, or just take it as is. The idea of free rent, the idea of concessions, the idea of the landlord coming off the asking rate in the industrial market anywhere in Southern California today just doesn't exist. And so you need to be prepared for that.
So what's the lag time between new construction? If the market didn't anticipate the Amazons of the world snatching up all of this available warehouse space because they're shipping more and more, particularly that last mile space where they can't just have the giant super centers where they collect all this stuff and distribute it. They've got to have some place closer where the trucks can pick it up and take it to your house here. If they didn't foresee that, and are they now trying to suddenly build lots of these industrial projects wherever they can? And if so, what's the lag time? When does that stuff come online?
Yeah, and the issue now with the current demand in the market is they're not building small to middle-sized buildings for the most part, very limited inventory for that. The new construction is much bigger buildings, and then most of these buildings are pre-leased before they're even completed.
Wow.
So the fact that it comes on the market and it's sitting and somebody says, oh, I can't rent it, so I'll make a deal, is just not happening. And so You see people making deals now, and then they deliver the building in 6 or 12 or 18 months, and the market's already shot up. So the guy who signed the lease 12 or 18 months ago got a very good deal by today's standards because the rents continue to keep climbing. So at the moment, you just don't have any new inventory. And then the only thing you do have is you have companies that maybe move to bigger space, which opens up space, but you still have all these guys, like Matthew, chasing it around that are looking, and then, they try to find something. And so it's a challenge. I mean, there's no question. We have clients that bought industrial buildings in the Inland Empire 12 months ago, 18 months ago. Those buildings are worth almost double what they bought them for.
Wow.
Right? And so on paper, you made millions of dollars, and you're glad you did it. For those that, extended their lease for a year because they weren't sure where their business was going or how much space they would need, the good news is they bought themselves some time. The bad news is you're just going to pay more at the end of the day. And so, but you also, Paul, you need to look at it too. The guy who makes widgets, whatever he makes or whatever he does, the fact that he has to pay more rent, part of it goes against his bottom line, but part of it is he passes that cost on to the customer, which is what creates the inflation in the first place. Yeah. So, if I'm making wood boxes, the cost of that wood box is going to go up. And who pays? You and I, the consumer.
So let's flip hats here. We've got William from Santa Ana. He owns several of these commercial buildings in Southern California. And his fear isn't that he's suddenly worth more money on paper. His fear is, I've got significant increase in my costs and operating expenses. He says, seems like everything's gone up, from taxes to insurance to janitors to utilities. And many of the tenants are still locked into what we would now regard as below market rents. So how does he can't raise the rent as they're locked in for a period of time. How does he pass these costs along, and how does he do it in a way that doesn't get everybody upset?
Yeah, well, that's a challenge. Look, nobody likes getting their rent raised. Nobody likes having more costs thrown upon them. So from William's perspective as the landlord, he's getting hit with cost increases, which is hurting his bottom line. And then, depending upon how the lease is structured with the tenants, in many instances, if it's a triple net lease, if it's a retail lease, if it's an office lease, you have the ability as the landlord to pass these increasing costs, at least the pro rata share, onto the individual tenants. And so if the janitor went from $1,000 a month to $1,100 a month and gave a 10% increase, that increase could then get passed on to the tenants. And so it's a difficult conversation on the one hand, because as the landlord, you got to go tell your tenants you got to pay more. On the other hand, it is a legitimate reason for raising whatever that reimbursement or that pass-through is, because you can justify the fact that you're not making any more money. You just got hit yourself. So it's a catch-22. You have to explain it. Nobody likes to hear it, but if you explain it properly, then most people, at least in today's world, understand what's going on.
And so, do you do it just next month? Or
Well,
do you give them some warning?
again, you got to look back to the leases and see what they say. But typically, you have the ability once a year to be able to reconcile these expenses. You're not going to call up this month and say the janitor raised my price, and then next month Edison raised my price. You do it once a year, and then you give people an explanation, and you'll have to give them a spreadsheet or something laying out what those increases were, so somebody could actually understand it.
Right.
And so, William, good luck to you. We're in the same boat on our end as many other landlords, and that's why you see these new leases going forward, which really gives more liberal opportunity for the landlords to pass these costs along, because I don't think we're done.
Yeah, I don't think so either. So that poses another question from the investor perspective. Malcolm from Newport Beach writes, I have cash available. I'm looking to invest into something. I'm thinking real estate. However, the cap rates in apartments are only 3 to 4%. The cap rates for single tenant net investment properties are in the 4 to 5% range. He says, I'm looking for a higher yield. What do you suggest I do? Where do I put it?
You and me both, and everybody else out there, right? I would say that if Malcolm sounds like a guy who'd like to have his cake and eat it too, which I'm one of those guys as well. The problem is, at the moment, you have interest rates that are now in the 4 to 4.5% range, depending upon who you're talking to and what kind of loan.
And may go higher.
And will go higher. And so if interest rates go to 5%, the cap rate at 3 or 4 or 4.5, if you put down 50% and you get a loan for 50%, you're losing money on the 50% that you put down, because the part that you borrowed is then going to chew up part of your profit. So if you bought something at a 4 cap, you financed half of it at 5 cap, you'd only be getting 3% on the money that you actually put down. So it's just going to hurt the return. So the question really will be, going forward, as interest rates go up, will the cap rates go up as well? And if the cap rates go up, that means prices level off or come down, because who buys a property at a 3% return and then goes and gets a loan at 4.5% and then actually gets worse than 3%? Although I got an email this morning from somebody where they sold an apartment building in Costa Mesa at 1.9%.
Oh, wow.
And somebody bought it. And so I guess the issue is back to, what do I do with my money? Because if someone sold their house or sold their other building that they had and they made a bunch of money and they don't want to put it in the stock market because it's too volatile and they don't want to pay Uncle Sam, then they're better off just buying something even if it has a minimal return. And so the answer for Malcolm is, it's a tough one. You have to decide, what is it that you want? Do you want a quality property? Are you focused on return and you don't care where the property is? Because there are better yields outside of California. You can go to other parts of the country and get higher cap rates, but those properties will not appreciate as much in a hot market as we've seen. And if you live in Southern California, you can't feel or touch it. And if you don't care about those things and you only care about the yield, you should go outside of California for sure. If you really want to feel and touch it, or you like the fact that, hey, my property went up a bunch in value, you're just going to get a lower return.
How important is it to feel and touch it, to feel comfortable that I can go out if there's a problem, or I can actually look at it and look at the neighborhood, or I just buy portfolios sight unseen in Tennessee or
yeah, I think that's a personal preference. Some people could care less. I'm never going to go there. I'm never going to look at the property, and I'll either hire a property manager or I'll get a property with very low maintenance or no maintenance in the case of a triple net type of a setup, and I just want to get a check. But other people say, hey, I want to drive by there. I like the pride of ownership.
Or to feel comfortable that somehow you
so,
can put your hand on it. If something goes bad, I can get there. Yeah.
Right. So either you're moving to Tennessee so you can feel and touch your property,
right,
or you're not looking in Tennessee. Right. So you got to decide. Pick one.
Okay. Well, we're down to the last couple of questions here. We got a lot of them left in the bag. Let me see if I can get a good one here. Let me reach around to the bottom here.
Is one of those what's for lunch, or no? We're going to stick with the real estate?
So far, I haven't seen that one. They're a little more panicky than that here. I'll tell you, this is sort of a summary of a couple of them here. This one guy wrote this, and I think he speaks for a lot of people. Avery from Garden Grove. Knowing that you own a lot of apartment buildings, what do you say to all these tenants out there who've struggled to pay their rent during COVID, and now they're looking to either work with the landlord, or they're trying to find a new place because they couldn't hold on to this one, and the landlord's saying, hey, why should I let you in because you didn't pay the last guy? You know, it seems like there's a lot of people in trouble, and it's been a soft landing. It wasn't the huge crash that we feared where all these people are suddenly going to get thrown out on the street, and what do? But they've still got damage that they've got to deal with as they rent new places. What do you tell these people?
Yeah, that's an ongoing one. We deal with that all the time with our own business, and I'm sure other landlords do as well. Look, if you struggled to pay what I'm going to call yesterday's rent a year ago during the pandemic, and maybe you got assistance from the government, maybe you got caught up, maybe you now have a new job and you're paying more and you're on better solid feet, you still now going forward have to convince the landlord that you have the capacity to pay the rent in a timely fashion, and that you have the income to be able to support that, to justify it. And then the issue is, from the landlord's perspective, if you were struggling to pay yesterday's rent, and clearly the market is much higher and your rent is going up by some degree, whatever it is, how is it that I'm going to feel comfortable doing business with you, that I'm not going to be calling you every month for the rent? Then the issue is, some tenants say, hey, look, I want a different area. If I'm going to pay more, I want a nicer place. If I can't pay anymore, I need a smaller, cheaper, less expensive place. So I got to go look around. And now the issue is, if I have dings on my credit, or I don't have my ducks in a row going and looking for another place, you're going to get shut down, just like the guy who's out there bidding, trying to buy a house. You go to look for an apartment, stuff rents in a matter of a couple of days. And so you're competing with other people out there. You should, run your own credit report so you know what it looks like. And if you do have dings on it or marks, try and either explain it away in a cover letter or fix it. If you owe the cable company $100 and it's hurting your credit score, pay it, and then just get it off your score. And so writing a cover letter, having income verification, maybe having a rental application already filled out, a generic one, even a picture. I mean, these are things that are going to help tell a story. And as a landlord who looks at applications all the time, it tells me that you put some thought into it and you're like a more responsible person, as opposed to somebody who fills out the application, doesn't complete all the boxes, and then says, oh, by the way, I've got an 80-pound dog that I forgot to tell you about, and tries to slip it in at the end of the day. It's a challenge. It's a challenge from a credit standpoint. It's a challenge from just an income and a payment standpoint. So I would say do your homework. If you're looking for a place, put your own profile together so you can present it and make yourself look as good as you can.
Well, it's a challenge to get them all in. I appreciate the number that we've addressed this morning, and there's 100 more we could talk about here today. We'll have to do this again sometime here, because there's no question, there's a lot of questions about the state of commercial real estate these days. Where's it going? Where's it headed? Is it still hot in Southern California? Should I look elsewhere if I'm investing? All those and more are the sentiments that I'm reading here today. Any final takeaways here? Any final thoughts on you can share with people? How are you feeling? What keeps you awake at night right now?
Yeah, right now I'm just dealing with jet lag from my vacation, and so that's what's keeping me awake at night. But in terms of where things go, there's no question, what continues to happen with interest rates and what impact that's going to have on people's decision making. And then clearly the volatility in the stock market is not helping anybody's cause. I think the issue in Ukraine, it looks like it's going to be a longer haul. I mean, this thing's not going to be over in a week or two. So I heard this morning on the news, you're going to just expect to pay continued high prices at the pump.
And wheat and other things here, because they grow a lot of wheat there and stuff too. So
well, and
it's
it's natural gas and it's all other things that flow through to Europe and then just get passed on to us here.
Yeah.
That's the bigger picture. The micro of it is you go to the grocery store, stuff costs more. You go to the restaurant and things cost more. And you still have people, I talk to them all the time, are struggling to find good people to work for them, to be able to run their business efficiently. And so I think all of those things going forward, for the average person, I would save some money. Don't go out and blow it because you don't know where things are going. At the same time, you got to expect that when you go to buy stuff, things are going to cost a little bit more. I tried to buy some new running shoes online, and they were like 3 times what my last pair of shoes were.
Yeah,
so.
Right.
For those people out there, I guess I'd say stay tuned. We're going to have some guests coming up in the next few weeks to actually talk about some of these bigger picture things relative to the economy as a whole, the upcoming elections, inflation, interest rates, and all that bigger picture stuff, and how that relates back to the average person here in Orange County.
Stay tuned. More to come as we continue to talk real estate here on Let's Talk Real Estate, right here in Orange County's only community radio station, OC Talk Radio. Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California Irvine's Beale Applied Innovation Center.